Now I'd like to sort of use the statutory framework as a basis for sort of going through the various issues. And my goal also of using this, as a basis is that, as I've said a number of times, 90% of your answers come from reading the code. So if you do in fact go back, spend some time with the code and with regulations, you'll be a lot farther along than you would be if you just read what's in the text, or if you just listen to me. So please do use these things as a reference tool. I've tried to include code sections so you know where to look for what we're talking about. One thing, we start out, as I've said before, there's 951A1A. I'm sorry, 951A1, which includes both A1A and A1B, Subpart F inclusion, and the investment in U.S. property inclusion. Now, notice that those are always referred to as inclusions in income. They are not referred to as dividends. Since we work with the law, we have to read the law carefully and see exactly what words are used. And the words used do not include the word dividend. And that has some significance to us. Well, if it's not a dividend, not an actual dividend, then 902, which is your deemed paid foreign tax credit, does not directly apply because it only applies to actual dividends. This is an inclusion in income. So that forces a section within Subpart F to give you the deemed paid tax credit, which is your section 960. And in terms of other consequences, I think you're aware that there's a special 15% tax rate on qualified dividends. That's your section 1H11. And that's only actual dividends. A Subpart F inclusion does not receive the benefit of the 15% rate. So if you're planning on distributing money, plan on making distributions, which would be taxable as a dividend, and assuming that you have a situation where it would be a qualified dividend under the 1H11 rules, then you want to avoid Subpart F at all costs, because all of a sudden that's a 20-point tax difference. Anybody have an obvious way to avoid Subpart F completely, if that's an issue? We haven't talked about what is a CFC, so just think back on the last, this is what, class session 5, I think? Think on the last 4 class sessions. What have we occasionally talked about that might be relevant here? Well, what about the entity classification rules, the check-the-box rules? If we check the box on the corporation, then we no longer have a corporation for U.S. tax purposes. There's no CFC. And, of course, that will make the owner legally the taxpayer. Now, of course, if he's the owner and just is considering the business of that company as being just like a proprietorship if he's an individual, or a division, an overseas branch if it's a company shareholder. Then, of course, from a foreign, you're not going to have a dividend, so we don't have that one. I'll get to you in a moment. We don't have a dividend because, you know, we don't have a corporation making a distribution with respect to stock. If it's a disregarded entity, you know, under the check the box rules. But it does mean that the owner, to the extent there is tax paid by that entity, that disregarded entity, there will be a foreign tax credit. So we avoid subpart F, but we then will have whatever tax results from including the income directly in the owner's hands and taking a tax credit for any taxes paid. Yes?
In practice, though, do you think that an owner of a foreign corporation would want to be liable for the tax? Would even check the box and disregard the entity?
That's a good question. It depends on the situation in practice. For example, if the foreign corporation is in a country which has let's say a good healthy tax, it doesn't have to be a high tax, but let's say a good healthy tax rate, the owner may very much want to elect transparent treatment, because then with the tax credits that come up, he pays a minor amount of U.S. tax, and he has, you know, a complete access from a U.S. standpoint to the earnings. He doesn't have to worry about, gee, how do I leave those, you know, earnings down in the company and use them in some fashion. He doesn't have to worry about all these things. On the other hand, if the company is in a country that has a zero tax rate and it's earning income which is not taxed in any country of operation, which might be different from the country of organization, then he's probably not going to want to check the box and have it be transparent, because it would, you know, give him immediate taxability. Now, of course, subpart F, if it happens to be this tax haven type of income, will force current taxation on him anyway. But if it's not tax haven income, then he can achieve some deferral. And as long as he doesn't, again, use the money back in the United States in a way that triggers these investment in U.S. property rules, then he can have his deferral. And yes, he will want to have corporate status. So it depends on the situation, and is very much a facts and circumstances analysis. So, good question. 951B defines the term U.S. shareholder. U.S. shareholder has a very specific meaning when you're talking about subpart F. U.S. shareholder is only a 10% or greater owner. Only a 10% or greater owner. Anybody that owns less than 10% is not a recognized person, so to speak, for subpart F purposes. Completely ignored. As a result, one way of avoiding, you know, now that we're getting into more detailed rules, one way of how to speak English. One way of avoiding subpart F status is to have 11 shareholders all owning an equal amount, because they're all under 10%. And as long as they are not related in some fashion, that, you know, which under the constructive ownership rules would have to be recognized. As long as you have 11 shareholders, equal amounts, you're out of Subpart F, period. Now, that's nice to say, but of course, the economics are, if you have an idea for a business, do you necessarily want to share economically with 10 other people who are who you're merely inviting to the table because of a tax issue? Well, economically, that doesn't happen. So you don't see that happening in practice under normal circumstances. But again, if you have something which is going to be widely held, then yes, maybe you can avoid it. An interesting, just as another thought while we're on this particular subject, it often happens that let's say you're working for some closely held business. And by closely held, I'm thinking of something that maybe has, 3, 4, 5, 6, who knows, shareholders. Could be more, could be less. Now, an obvious thing is, if this company X says, gee, I want to set up a subsidiary in a particular location to do something, and let's say whatever it is going to be something we have Subpart F concerns about. If it sets it up like this, then you know it's going to be a CFC because it's 100% owned by a U.S. person, which is X. But you have a choice. You could, instead of doing that, you could set up, in a sense, a brother-sister company that's owned by the shareholders. And if there are enough shareholders, you might have your 11 people owning an equal number, an equal amount. That could happen. Or you might decide that this company, because it would, maybe there's too few number of shareholders, but maybe based on the business needs, or let's say the business that it will conduct, it will be subject to some amount of tax, and maybe you want to check the box for this company. And you end up with a better answer for the shareholders. Now, a public company situation would never want to do this because they want to control everything. Management wants to control everything. So you have a structure that is like a pyramid. The public company at the top and subsidiaries going down. But in a closely held situation, you could have this. Notice that direct ownership can include other forms under your substance versus form concepts. And just I've noted as an example, a 1982 ruling where an option to purchase stock was structured in a manner that, in the mind of the service, gave the equivalent of actual ownership. Okay, we have a non-resident alien, and he goes ahead and sets up a company which he owns directly, and he sets it up with $100,000 going into the company, and of course he receives back 100% of the shares. He then enters into an agreement, an option agreement, with a U.S. person under which the U.S. person, let's see, as I recall, paid $70,000 for the option to buy at a strike price of 30. What does this mean economically? At any time, the U.S. person can choose to purchase the company at 30. Now, if the business of this company X, if the business of that company had a lot of losses unexpectedly, and the value of this company fell, let's say, to $29,000, would the U.S. person still want to buy it? Well, presumably not, because he'd be better off letting the option lapse and not exercise the option to buy. So there is some real, in a sense, economics to this option. There's certainly the possibility that it might not be exercised, but the service looked at this and said, gee, a 70% fall before it's no longer makes sense to exercise the option means that economically we will treat this fellow as the owner, and therefore because he's the owner and he's a U.S. person, we have a CFC. So direct ownership can include, let's say, under substance concepts, something other than direct ownership. Now, we'll say a few more words about it later, but not too many. There's very complete rules for attributing ownership through other entities, making sure that if you will be considered to own what certain other persons own, so constructive ownership rules. You find those rules in Section 958. We won't say too much about them because there's just a lot of detail there, but understand that they're very broad rules. Does it make sense that there would be broad indirect ownership rules and constructive ownership rules? Yeah, it makes sense because Congress wanted to cast the net as wide as possible to capture as many situations as possible where U.S. persons controlled a foreign corporation. So we find that to be very broad. Remember, by contrast, when we looked at Section 902, there were no constructive ownership rules. Remember, for 902, which was your deemed paid foreign tax credit rules, there was a 10% ownership requirement. But since that's a rule which is giving you a benefit, you better own directly. There's no constructive ownership rules. So the purpose where you find an ownership test, the purpose is going to dictate whether you should expect to find some constructive ownership rules or not. Don't think of them as just, gee, they're rules to learn. It's, well, why are there rules there? And if this is something meant to beat on the taxpayer, expect a wide net. Okay, I've already mentioned, I think, about the 951A1 rules as to what's included, the A1A amount, the A1B amount. 952A is your specific definition of subpart F income, and it lists out a bunch of things. Only one of which, the second item, includes the foreign-based company, foreign personal holding company income, foreign-based company sales income, foreign-based company services income. Those are all within that second item, foreign-based company income. The other items are additional items that are included in Subpart F. Your insurance income, international boycott income. In other words, if you do certain business in boycotting countries and you agree to participate in the boycott, then there's an inclusion in income for that. There's also a loss of foreign tax credits. There's a bunch of ways that you get beaten for that. Notice the amounts of illegal bribes and kickbacks that you've paid. So presumably that is another reason why you shouldn't do it, aside from the social responsibilities perspective. And of course, income derived from terrorist supported countries. So there's a number of these other items, but the only one that we're really going to focus on is the second one. There's a few restrictions on what would otherwise be Subpart F income. And ignoring for a moment the first one, which is U.S. source effectively connected income that the CFC might earn. The other three all have to do with there being deficits in earnings and profits, either of the CFC itself or of other companies in the same chain. So if you look at this situation where a parent owns a CFC, and let's say that CFC owns, let's say that CFC1 and then there's CFC2. If we're focusing on this one here, there's three limitations that are focusing on deficits in earnings and profits. One is, of course, does this one itself in the current year have a deficit in earnings and profits? So, for example, how could that happen? Let's say that this company has, let's say, two activities. One is it conducts some business which has, which is not a tainted activity. And let's say, secondly, it has some foreign personal holding company income from interest and dividends, that sort of thing. If in the current year the business has a loss, then that will effectively reduce the amount that has to be recognized as Subpart F income because of the foreign personal holding company. So if you have, let's say, 100 of foreign personal holding company income, which would normally be taxable, directly to the shareholder, but this business for this year happened to lose 100, then there's no need to recognize anything at the X level. So if there's a deficit in the current year. A second possibility is that maybe we're profitable this year, but maybe we have a deficit from a prior year. That can be used to reduce Subpart F income. And then thirdly, maybe there's a deficit in the current year here. If there's a deficit at the lower tier level in this example, then that can reduce the amount of subpart F income at this level. Now, don't worry unduly about this aspect, but just understand that there are some ability to use deficits that are in the chain. Yes, Peter?
It seems like that might be easy for a corporation to abuse those rules by having a loss company somehow acquiring or manufacturing losses and using those to offset the foreign personal holding company income.
Well, definitely, no question, if a company knows that it's going to have some losses, then yes, it could plan ahead and attempt to, yes, achieve some good results here. At least from my experience, most businesses think they are going to ultimately make money. They may have some startup losses, but they're normally a little more optimistic.
Right.
And as a result...
But I mean, purposely set up a company that's going to have losses.
Well, you don't purposely set up a company that will have real economic losses, because a dollar of loss is always going to be worse than paying a little bit of tax. So I think it would be unusual for that to be the case. Now, yes, if somebody wanted to set something up and then manufacture losses that are not real economic losses through bad transfer pricing, yeah, you could do that, but then you're subject, of course, to getting the transfer pricing corrected, during the course of an audit or what have you. So, and also, especially with publicly held companies or any company which is big enough to have the need of an audited financial statement, they can't do things that are too ridiculously blatant in this regard. So I don't think this is something that's, in a sense, planned out ahead of time too often. Yes?
I know we're not too worried about this, but I'm just curious how long you can carry forward the losses. Is it indefinite or?
For this particular purpose, I believe it's indefinite. You have to look back at the rule, but this is not the equivalent of the use of a net operating loss, under your Section 172. This is just for purposes of calculating your subpart F income. So I don't think there's any life on it, but you'd have to look at it to be sure of that.